Hey, listen, we need to have a serious talk about the Golden Cross. You know exactly what I'm talking about. It's that first thing you read on a forum when you are starting at trading. When the fast line crosses the slow line, you buy. When it crosses down, you sell. Sounds amazing, right? Let me guess. What happened when you tried it with real money? First, you got chopped out to pieces. You bought the exact top, you sold the bottom, and you slowly bled your account dry. I've been in this game for over 30 years, and I've seen thousands of traders come and go because they treat indicators like magic wands. When they think that the moving average is going to predict the future. But here's the brutal truth. Moving averages are lagging. They're lagging instruments. If you use them to blindly trigger trades, you're going to lose, period. But does that mean that they're useless? Absolutely not. That's like saying a screwdriver is useless because you try to spread butter with it. It's messy on toast, but you can't beat it for tightening screws. So the tool is not the problem. The application is the problem. Today, I'm going to show you how professional traders actually use moving average. I'm going to teach you how to use them to gauge market strength, how to time your entries so you stop chasing prices. And finally, I'll show you how to ride trends until the wheel fall off. No fluff, just what actually works. There's a great analogy for this that I want to drill into your head. Imagine a race between a Ferrari and a Toyota. In a straight race, the Ferrari wins, hands down. It has more horsepower, better engineering, more speed. But does that mean the Toyota is a useless car? Of course not. If you need to drive your family of five across the country cheaply, reliably, the Toyota wins all day. The Ferrari can't do that. So you see, the value depends entirely on the context. This is exactly how you need to look at moving averages. Stop asking them to be a crystal ball. It's not there to tell you what will happen. It's there to summarize what has happened so you can see the context. Is the market cheap right now? Is it expensive? Is it strong? Is it weak? If you stop asking the indicator to predict the future and start using it to understand the present, everything will change for you. All right, let's get into the first tip. Relative strength. Most of you are picking the wrong fights. You see a stock or commodities that's beaten down and you think that you need to buy it hoping that for a recovery. But what you're really trying to do there is catching a falling knife. In this game, we want to back the winner. We want to bet on a horse that's already leading the race. Look at these two charts on my screen. On the left, we have the price of silver. On the right, the price of crude oil. I always keep the 7, 20, 50, 100, and 200 EMAs on my chart. And what you see here are what I call the EMA clouds. On the silver chart, here on the left again, the cloud on top shows the difference between the 7 and 20-day EMAs. The second cloud shows the difference between the 50 and the 100 EMA. And finally, the bottom cloud is the 200-day EMA in purple. Look closely at the right chart. The price is really messy. It's chopping around, and right now it's been sitting mostly below the 50 EMA. It looks heavy. It looked weak. Just with recent events in Iran, have we seen the price breaking through the 50-100 EMA cloud, which could be the sign of a recovery. Now, look at the left chart. The price structure of silver is almost an inverted picture of the oil chart. Where is the price? It's been surfing above the 7, 20, and 50 EMA clouds. It's been holding those lines like a floor. If I asked you, which commodity today would you buy? Do you buy the weak one that's struggling? No, you buy the one that's already showing you it wants to run. You buy the one above the 50 EMA, the one that shows this convergence of prices going up, EMA is trending up, and showing higher highs, higher lows. This is relative strength. You see this? When all the signs line up, it is so much easier to be long silver rather than agonizing with this choppy crude oil market. Why make trading harder than it needs to be? Find the asset that's respecting the moving averages and showing strength. Ignore the laggards. Now, let's talk about the thing that kills more account than anything else. The fear of missing out, also known as FOMO. My secret number 2 is finding the area of value. Look at that chart. You see a massive green breakout candle. The price is going vertical. Your heart starts racing and you think, I gotta get in, the train is leaving without me. No, you don't get in. Price is like a rubber band. If you stretch it too far away from the moving average, it will snap back. It's simple physics. If you buy when the price is far away from the MA, your stop loss has to be too wide to be safe. And statistically, you're likely to buy the exact top before the pullback happens. So look at this chart here. See how the price respects the 50 EMA? Then we get an overnight news. The price gaps up massively, breaks out, it runs, but then what does it do? It comes back. I'm going to show you, look at my 10 minutes bar chart now. Right after the open, the price just gets crushed all the way to what? I'm asking you, the Cloud 50-100 based on this 10 minutes time frame. It touches the 50-100 EMA band, then it bounces. It shows that this set of EMA class can be applied to all time frames, being short-term or long-term. That touch here, that's your area of value. You need the patience of a sniper. You don't shoot when the target is running erratically across the field. You wait for it to stop. You wait for the price to come to you. Let's do the math. If I buy the breakout at this top here, right when the market opens, my stop loss needs to be very wide. That's a huge risk. But if I wait for it to pull back to the 50 EMA on my short-term time frame, now my stop loss is a lot closer because I can use my Cloud 50-100 as a buffer for my stop loss. I can buy a bigger position size with less risk, and that is how pros trade. We don't chase, we stay patient, and we wait for the timing that gives us the best probabilities of the trade. Secret number 3, the path of least resistance. I like to keep my macro view very simple. I used the 7, the 20, 50, 100, and 200 moving averages on the daily time frame. As a matter of fact, on all my time frames. They are my compass. In general, my rule is that no matter what time frame you're looking at, whether it's daily, 1 hour, 4 hour, weekly bar chart, I always see my 50 EMA as my strong magnet keeping my medium-term trend together. But I see my EMA 200 as my ultimate line, the last line of defense. If the price is below the daily 200 EMA, I'm only thinking of selling. I don't care about how good the buy setup looks on the 1 hour chart. If the daily is below the 200, it means the big money is selling. So I want to be selling, or at least not opposing the flow. If it's above, I'm only thinking about being long. This keeps me on the right side of the tide, and I don't swim against the ocean. But hold on, and this is huge. Listen to me closely. Price action is king. You got to look at the market structure. You got to keep in mind the price context. Are slamming into massive historical support level? Do you short here just because the price crossing the line tells you to do so? Absolutely not. When the indicator fights price action wins. Every single time. The 200 EMA is a great guide, no doubt, but it's not a god. Use your eyes. If we hit major price support, I don't care if the price goes crossing the moving average a bit below. I wait a bit. I wait for my price confirmation, but I'm not selling blindly. And finally, secret number 4, riding the monster trend. The hardest part of trading isn't entering, it's holding. You see a little profit, you get scared, you sell, and then you watch the asset go up another 300 or 400% without you. It really hurts, right? You can use moving averages to trail your stop loss, but you have to choose the moving average according to your personality type. There is no best number. If you use the 20 EMA, you lock in profits fast. This is for the aggressive traders. But look there, you get shaken out on the first dip. There, the 50 EMA, this is the sweet spot for many. Like I always say, it helps you ride the medium trend. You give the market enough room to breathe. And if you really want to catch those life-changing moves, riding the wave for as long as you can, you use the 200 EMA. However, look at the chart. To ride this purple line, you have to be willing to see through massive drawdowns. Meaning you have to watch your paper profits drop by 20, 30% sometime or more and not panic. Can you handle that? If you can't, stick to the 20 EMA or ride the 50. Don't try to be a hero if your stomach can't handle the volatility. You have to know yourself. You have to know what you're capable of, and most importantly, what keeps you at bay, able to ride the trend that the market is willing to give you. Now, here's the bottom line. Trading isn't about finding a magic line that turns green when you should buy. It's about building a case. It's about a confluence of factors that make your probabilities better. Now, I'd like you to close this video and go to your charts. Plot the 50 and the 200 EMAs to start with. Look for the strongest market, the one surfing the lines. Then you can add the shorter EMAs like the 7 and the 20. Wait for the pullback to the area of value and stop chasing the noise. It's taken me many, many years to realize that simple is better. Just be bold enough to wait for the market to come to you and bold enough to ride the trend when you catch it. Now, if you found value in this video, just hit the like button. It tells me that you want more of this real talk, less of the get-rich nonsense, but keep it simple. Stay disciplined. I'll see you in the next one.